Good day, ladies and gentlemen. Today I want to teach you a very important concept, so you need to pay attention. The concept I'll teach you today is necessary for you to understand what I'm going to be teaching in the video tomorrow. Tomorrow I'm teaching a very powerful strategy, and if you don't understand this concept I want to teach you in this video, the strategy video, you won't be able to follow us when I'm explaining it, okay? So that's why I want to take out time to explain this concept today, and it has to do with the concept of fair value gap and inverse fair value gap. Many of you already know what a fair value gap is, but not everyone knows what an inverse fair value gap is. So I'll start with fair value gap. Fair value gap is simply a gap, or should I say a space that forms between three candles, okay? And for you to mark out that space, it's usually the first candle's wick does not intersect with the third candle's wick, okay? Meaning that the first candle's wick does not meet, okay, the third candle's wick. So I have an example here to show you what I'm talking about. This is your first candle, this is your second candle, and this is your third candle. Most times it forms during aggressive move in a particular direction. So if it is bullish candles that formed it is called a bullish fair value gap, meaning you have to, once you have drawn out the gap, you wait for price to come back to that gap, and then you take a buy trade, okay, a buy entry, in order for markets to move in the upwards direction. That's basically how fair value gaps are used, okay? So you can see what I did. I used an horizontal line. I placed it on the end or the tip of the first candle's wick. Then I placed another horizontal line on the wick of the third candle. Then I now have a space which forms here. You can see the space. That space is what we call FVG. That's fair value gap. And the idea is market will always move back into that gap, then move in the direction of the candles that form the gap, okay? So if it's bullish candles that form the gap, you're expecting to take a buy trade. It can also happen in a bearish scenario where you have three candles moving in the bearish direction, then the gap is formed. You use your horizontal lines to mark out the gap. When market comes back to that gap, you want to take a sell trade. You understand? And see exactly what happened here. Market came back into this gap and then did what? Gave us a buy opportunity, okay? So something else you need to know is that markets can decide to just touch the top of the gap, okay, then move up. Sometimes markets get to the middle of the gap, then move up. Sometimes it gets to the end of the gap, then move up. Sometimes it's wicks below the gap a bit, probably trying to grab liquidity, then move up. So those three options are possible. That's why we usually place our stop loss, a few pips below the fair value gap, okay? Then sometimes you can decide to just put if you are desperate to enter the trade, you can decide to put your entry, probably your buy limits, you put it at the at the top of the fair value gap that you have drawn, so that you won't miss the trade in case the market just taps the top and moves, okay? You place your stop loss definitely below the fair value gap. Some other person's system, they will place the buy limits at the bottom here, so they don't want drawdown. They don't want anything that will make their heart beat faster, so they don't want any drawdown. They want the market to just tap and start moving into profit immediately, while some others will place at the middle. There are different entry scenarios, so it depends on the trader, okay, whether you are conservative or aggressive. Aggressive trader does not want to lose anything, and he does not want to lose any trade, and he does not mind doing being in drawdown. If he sees negative balance, it does not bother him, so long he's sure of his strategy. He believes it will still go in his direction, okay? So he doesn't want to miss any trade. Anyway, that's fair value gap. Okay, so for the inverse fair value gap, I have a GBP USD example for you. So let's go there. Okay, right now, before I enter the GBP USD trade, I'm happy to see that I'm actually in profits in my USD card trade, okay? For that to be blue, that means I'm in profits. I was in a little bit of loss before, I was thinking it with my stop loss, so it's a good thing I'm now in profit. So GBP USD, let's go. Inverse fair value gap, I've already marked out a good example, so I don't waste time searching for the example, okay? So Where is it? Where is it? Where is it? All right, I found it. So this is it right here. No, not this. Okay, I found it. So this is it. Hope you can see the first candle is right here. This is my first candle, and you can see I put an horizontal line just at the tip of its wick. Okay, and this is the this is the third candle, and I also have an horizontal line at the tip of its wick. Let me balance the horizontal line well at the tip of the wick. Okay. And I also have this one. Let me balance it well at the tip of the wick. Okay, so you have that. Now what constitutes a fair value gap is still an inverse fair value gap. It's still going to be a fair value gap. The only thing is it's a fair value gap that is disrespected, meaning price brushes through it. Okay, price drives through it. So after price has driven through it, price is going to come back to retest the region where that fair value gap is before moving downwards. Okay, so you can see what happened. Price came back to retest that region, then moved in a downwards direction. So that's why we call it an inverse fair value gap. A normal fair value gap, as you can see that I use bullish candles to draw it. It's supposed to it's supposed to retrace into the gap, then move in the upwards direction. You know, that's the normal fair value gap. So what constitutes an inverse fair value gap is that market is going to break through it as if it is not there. Okay, then come back to the region, then move in the downwards direction. So if it's bullish candles that form the inverse fair value gap, market is going to move downwards. And if it's bearish candles that form the inverse fair value gap, market will move upwards. Okay, so that's the idea. But the first concept is that market is going to break through, the price is going to break through the through the gap without respecting it. It will break through the gap. Once it has broken through the gap, it will then come back to the region where that fair value gap is, as if it wants to retest it, then continue moving in the downwards direction. If it is bearish, it will continue moving in the upwards direction. Hope you understand the difference. Okay, so broke through it, came back to the region, then move in a downwards direction. Perfect inverse fair value gap. Okay, so this concept I've taught you will really help you to understand the strategy I want to teach you tomorrow. Very powerful strategy. You are going to love it, but this knowledge is important for you to understand that particular strategy. Okay, so if you got any value, please subscribe and turn on the notification bell. I'll see you in the next video. Thanks for watching. If there's any part you don't understand, you can send me a message in the comment section. I'll respond to it. Thanks for watching once again.